Hey everyone, welcome back. We're doing something a little different today. Well, I guess not totally different from our normal content, but,
It's like enough.
yeah, different enough that it needs special attention. Today, we're diving deep into the S&P 500.
The S&P 500, one of the most well-known and influential stock market indices in the world.
Exactly. And what we're really interested in is trying to predict changes to the index.
Yeah.
Like which companies might be added or removed. Because,
That kind of knowledge could give investors a serious advantage, right?
oh, absolutely. Just think about Tesla back in 2020.
When they were added to the S&P 500.
Yeah. I mean, their stock price went through the roof. Imagine if you had known that was going to happen beforehand.
That's the kind of opportunity we're exploring today. This deep dive is based on some really interesting research coming out of Columbia University.
Yeah, they're using machine learning to try and predict these changes to the S&P 500.
Machine learning.
It might sound a little intimidating, but at its core, it's about training computers to spot patterns in data.
Huge amounts of data. And in this
Now,
case,
data is all about companies and their financial performance and market trends and all that.
right, they're basically teaching a computer to become an S&P 500 expert, to be able to sift through all this information and identify the subtle signals that humans might miss.
Okay, so before we get into how they actually did that, let's just back up for a second. For anyone who maybe, needs a refresher,
Sure.
why is the S&P 500 such a big deal in the first place? I mean, it's not just another stock index, right?
Not at all. It's considered a benchmark for the U.S. stock market as a whole. When you hear news reports about the market going up or down, they're often talking about the S&P 500.
Right. And so many investors, especially big institutional investors, use it as a guide.
Absolutely. And then with the rise of passive investing, where funds just try to mirror the S&P 500, well, any change to the index can have massive ripple effects across the market.
It's not just about the companies themselves. It's about the vast sums of money tied to this index.
Right. Remember Tesla joining the S&P 500? December 2020. There was a surge in trading activity, their stock price shot up, and all that just from being added. Now imagine if you knew that was going to happen beforehand. That's the kind of advantage this research could potentially provide.
Okay, so the stakes are pretty high. So how did these researchers actually go about trying to predict these S&P 500 changes? I mean, it sounds like a really tough problem. It's got to be a lot of data they're looking at.
It is. They collected a massive amount of information covering a decade, from 2013 to 2023, using a platform called WRDS,
WRDS?
Wharton Research Data Services.
Got it. So it's like this gigantic library of financial information.
Precisely. And within that library, they pulled data from a bunch of different sources, like CRSP, the Center for Research and Security Prices.
CRSP, what do they get from there?
Daily stock prices, market capitalization, which is basically a company's worth, and trading volumes.
Okay, that makes sense. You definitely want to see how a company's stock is performing.
Right, but they didn't stop there.
Of course not.
They also used Compustat? Yeah. They were able to access even more detailed financial data from there, like a company's total assets, net income, and even things like financial ratios.
Financial ratios. Could you break those down for us? I mean, what are those and why are they important in this context?
Well, think of them as like insights into a company's financial health. You can see how efficiently a company is using its assets to generate profit. The higher the ratio, the better, right? It's almost like you're measuring a company's financial fitness.
So they're not just looking at how big a company is, but how well it's actually performing.
Exactly.
What other kind of data did they include?
They also factored in analyst coverage using a source called IBES,
IBES.
which basically tells you how many analysts are following a company and issuing reports on it.
So it's like a measure of how much attention a company is getting from the market,
Mm-hmm.
whether it's on people's radar.
Right. The more analysts are covering a company, the more likely it is that company's on investors' radars. And that can influence its chances of being added to the S&P 500 for sure.
Okay, so market buzz matters. I like it. Anything else they included in their data collection?
Let's see. They also pulled information from audit analytics about things like auditor changes and financial restatements.
Now, those sound like pretty specific details. What kind of insight can you even get from that type of data?
Well, it might seem minor, but, changes in auditors or the need for financial restatements, it could signal something about a company's stability and transparency.
So they're really trying to create this complete picture of a company by gathering all this different information.
Exactly. You got to go beyond just the surface level metrics to really understand what's going on, to get a deeper understanding.
Okay, so they've got this massive mountain of data. Now what? How do they actually use it to predict these S&P 500 changes?
Well, this is where the machine learning comes in. They use different machine learning models to analyze the data, looking for patterns.
So they're teaching a computer to become like an S&P 500 whisperer or something.
Exactly. The idea was to see if a computer could identify those subtle signs that might indicate whether a company is about to be added or removed from the index.
So did they just use one type of machine learning model, or did they try out like different approaches?
They tested a few different ones, yeah, starting with a simple one called logistic regression, just to kind of get a baseline.
The basics, okay.
Yeah.
Then what? What other models did they use?
They also explored more complex models, like random forest and support vector classifier, or SVC.
Random forest. Now that sounds more like something out of a fairy tale than like a financial model.
Well, it's actually a pretty clever way of combining a bunch of decision trees to make a prediction.
Decision trees. Okay, now I'm really intrigued.
Imagine each tree in the forest represents a different way of looking at the data, and each one kind of votes on the outcome. And the forest as a whole makes a decision based on the majority vote.
So it's like having a whole team of like financial analysts, each with their own unique perspective, all coming together to make a prediction.
It's a good way to think about it. And the random part comes from the way the data is sampled and the features that are selected for each tree. That randomness actually helps the model be more accurate and make better predictions.
Okay, that's pretty cool. So out of all these models, logistic regression, random forest, SVC, which one ended up performing the best?
Well, it turned out that the random forest model was the most accurate one. They got a test F1 score of 0.85.
A test F1 score. Okay, I'm going to need you to break that down for me. What does that even mean in plain English? Like, how do we interpret that score?
Sure. Think of the F1 score as a measure of accuracy. A perfect score would be 1, meaning the model predicted everything perfectly. So 0.85, that's pretty darn good. It means the model correctly predicted which companies would be added or removed from the S&P 500 about 85% of the time.
Wow, that tell us impressive.
Yeah.
So what did this random forest model actually reveal? What were some of the key factors that seemed to predict whether a company would get that coveted spot in the S&P 500?
Well, as you might expect, some of the findings were pretty straightforward, like market capitalization, operating income, book value per share, the classics. Essentially, the bigger and more profitable a company is, the more likely it is to be included in the index.
Yeah, that makes sense. Bigger companies, more profits, more likely to be in the S&P. But I remember you mentioned earlier that there were some more surprising factors too, right? Did the model uncover anything that you weren't really expecting?
It did. It was interesting. The model found that the 3-month average trading volume and the number of analysts covering a stock were also strong predictors.
Hold on, really? So the more a company's stock is being traded and the more analysts are talking about it.
The more likely it seems to be to get on the radar of the S&P committee. It really looks like that market buzz and investor attention can have a pretty big impact on a company's chances.
That's fascinating. It's not just about the hard financial numbers. It's also about perception and, like, momentum in the market.
You got it. It highlights how important it is to understand market sentiment and investor behavior. But another really important thing to point out here is that the researchers were super careful to make sure their model wasn't just memorizing the data. They used techniques to avoid what's called overfitting.
Overfitting. Now, there's another one of those terms. What does that mean in this context?
Think of it this way. Imagine you're trying to teach a student for a test by giving them the exact same questions over and over again.
Okay, I see where you're going with this.
They might ace that specific test, but they won't really understand the material, right? It's kind of the same with a machine learning model. If it just memorizes the data it was trained on, it won't be able to handle new information, new data. It won't be able to generalize.
So they wanted to make sure their model could actually adapt and make accurate predictions even when it was given new data, not just stuff it had already seen.
Exactly. They wanted to create a model that was intelligent, that could be given information about a company it had never seen before and still make an accurate prediction. And that makes their findings even more reliable, for sure.
Okay, this is all super interesting from a research perspective, but let's bring it back down to earth for a second. Did this model actually make any real-world predictions about S&P 500 changes? Like, did it get anything right?
Absolutely. It actually correctly predicted that Uber Technologies, the ride-sharing giant, would be added to the S&P 500, and Jabil, the electronics manufacturing company, as well.
Wait, wasn't Uber already in the S&P 500?
You might be thinking about their IPO when they went public and their stock started trading. But getting listed on an exchange is different from being included in an index, like the S&P 500.
Oh, right, right. So even though Uber was already public, the model was able to predict that they would eventually be added to this like exclusive club of the S&P 500.
Exactly.
Pretty impressive. So the model's got some wins under its belt. Anything else it got right?
It also correctly predicted that SolarEdge Technologies, a solar company, would be removed from the index.
So it can predict who's in A&D, who's out. Man, that's really something. If you had access to this kind of information, it could be huge EE in the market. Like you could really make some strategic moves.
You could. While no model is perfect, of course, this level of accuracy opens up the possibility for investors to capture what's called alpha.
Alpha. Is that some secret Wall Street code I'm not privy to?
It's a term that gets thrown around a lot in finance. Alpha basically refers to outperforming the market. It's like a measure of how much an investment's return exceeds a benchmark, like, the S&P 500.
So positive alpha means you're doing better than the market.
You got it. And that's what everyone's after, right?
Well, yeah. So theoretically, if you could use this model to predict S&P 500 changes, you could potentially buy the stocks that are likely to be added before the price goes up, or like sell the stocks that are about to be removed before the price goes down.
Yep.
Talk about strategic investing.
Now you're getting it. That kind of decision-making could lead to some pretty significant gains.
Okay, so this is really exciting stuff, but I'm guessing you're not suggesting that investors should just blindly follow every prediction the model spits out, right?
Definitely not. The model is a tool. It's powerful, but it's not like the crystal ball. You know what I mean? It's important to remember that there are so many other factors at play in the market, things that can influence the S&P committee's decisions, the overall economy, company-specific events, even things like, global politics. It's all connected.
So you got to take the model's predictions and then consider all those other factors too and use it all to make informed decisions.
Exactly. It's about taking all this data and using it to develop a smart, holistic approach to investing.
Right. Makes sense. So where does this all go from here? I mean, are the researchers just going to sit back and say, well, we cracked the code? Or like, are they planning on taking this research even further?
They're actually exploring ways to make the model even more powerful, to incorporate even more data. They're looking at things like ESG scores.
ESG scores?
Yeah, which measure a company's environmental, social, and governance performance.
I've been hearing more and more about ESG scores. Seems like investors are really starting to pay attention to them.
Yeah, investors are definitely starting to realize that a company's long-term sustainability and ethical practices are important factors in how well they perform. Adding ESG scores to the model could provide a much more comprehensive assessment of a company's potential.
Interesting. So they're adding ethical and sustainability factors into the mix. Anything else on their list of potential data upgrades?
They're also thinking about adding social media sentiment, essentially what people are saying about companies online.
Wait, really? They're going to analyze tweets and Facebook posts and all that? That seems kind of crazy. I mean, how is that even relevant to, like, financial predictions?
It might seem a little out there, but social media can actually be a powerful indicator of public opinion and brand perception. If everyone's buzzing about a company in a positive way, it could be a sign that the company's gaining traction, becoming more influential. But on the flip side, if the sentiment is negative, well, that could be like an early warning sign of trouble brewing.
I guess it's kind of like crowdsourcing market intelligence in a way.
You got it. Tapping into the collective wisdom or maybe anxieties of the internet.
Okay, that's pretty wild. Anything else?
They're also looking into incorporating real-time economic indicators.
So stuff like interest rates, inflation, economic growth, all those big picture economic factors.
Exactly. All those things can have a huge impact on the stock market, so including them in the model could help it respond in real time to the changing economic landscape.
It's like they're building a financial prediction machine that never stops learning, never stops evolving. What excites you the most about all this, about the potential of this kind of analysis?
For me, the most fascinating thing is that it's not just about investment decisions. I mean, this kind of analysis could be applied to all sorts of things, like risk assessment, for example. Imagine being able to use data to predict which companies might be more likely to face, like financial difficulties or scandals.
Wow, yeah, that would be huge. Not just for investors trying to avoid losses, but for regulators, policymakers, even just like everyday people trying to make smart financial decisions.
Exactly. It could help identify potential problems early on and maybe even prevent them from happening in the first place. It's a totally different approach to risk.
It's like proactive instead of reactive.
Right.
Right. trying to get ahead of the curve. I'm really curious about how this kind of analysis could be used to help make policy decisions, too. Like maybe governments could use similar models to identify companies that are at risk of failing or, engaging in unethical behavior.
It's definitely an intriguing possibility. Imagine regulators having these kinds of tools at their disposal. They could potentially intervene earlier, keep problems from getting worse, protect investors, and, prevent a lot of harm.
It feels like we're talking about a more like data-driven approach to
Yeah.
governance, where decisions are made based on insights gleaned from data instead of just gut feelings or like tradition.
It's definitely a step in that direction, and I think it has the potential to be hugely beneficial. But of course, we also have to be very mindful of the ethical implications. We have to make sure we're using these powerful tools responsibly.
Absolutely. I mean, just because we can collect all this data, it doesn't necessarily mean we should, right?
Yeah.
We got to be really thoughtful about how we use this kind of information and make sure we're not like violating people's privacy or perpetuating biases.
Couldn't agree more. Transparency, accountability, ethical considerations, all that needs to be part of the conversation when we're talking about data. Always.
Well said. This deep dive has been pretty eye-opening for me. We started out talking about using machine learning to predict S&P 500 changes, and now we're having this broader conversation about the future of data and how it could transform everything from finance to, like, government policy. It's a lot to think about.
It's a great example of how data science is changing the world, and we're really only just scratching the surface.
Okay, we've covered a lot of ground today, so let's recap the key takeaways for our listeners. First, we learned that machine learning can actually be used to predict S&P 500 changes with a surprisingly high level of accuracy. And these models aren't just looking at the traditional financial numbers, they're also incorporating things like social media and ESG scores, which is pretty cool.
We talked about how these predictions could give savvy investors an advantage and potentially help them outperform the market. But, as always, we got to remember that these models are tools, not fortune tellers.
Right. They should be used as part of a smart, comprehensive investment strategy. And I think one of the most important things we talked about today is the broader implications of this research. Like, it's not just about making money in the stock market. It's about how these tools can be used to assess risk, inform policy decisions, and even reshape the way we think about governance. It's really exciting stuff.
It really is, and the possibilities are pretty much endless. I mean, we're in the midst of a data revolution, and it's up to us to figure out how to harness its power for good.
Well said. So to wrap things up, I'm going to leave our listeners with a final question. If you had access to this kind of predictive power, what would you be most curious to investigate? What mysteries of the market or, the world in general would you want to try and unlock? Think about it. Maybe you'll be the one to make the next big discovery. Until next time, happy diving. It feels like we're just scratching the surface here, This whole idea of combining traditional financial data with things like social media and ESG scores, it's really fascinating.
It is. It really shows how data science is changing the way we think about the world. Even in, a field as old as finance, right? There's all this information out there that for a long time we just ignored or we thought it was too hard to analyze.
And yet, it has the potential to be so insightful. The whole idea of using this type of analysis for risk assessment, that's really intriguing to me. It could be a game changer, not just for investors, but for, regulators, policymakers, even just everyday people making financial decisions.
Well, right. If you were thinking about investing in a company, wouldn't you want to know if there are any hidden red flags in their data? Or if you were a bank and you were lending money, you'd want to be able to assess the borrower's risk more comprehensively, right?
For sure. It feels like we've relied on these traditional credit scores and financial statements for so long.
Yeah.
But there's a whole other level of insight that we're just starting to tap into now.
It's about going beyond just the numbers, what are a company's values? How is the public perceiving them? Are they addressing environmental and social issues? All those things can contribute to their overall risk profile.
And then there's the whole idea of using this kind of analysis to help inform policy decisions.
Yeah.
And maybe governments could use similar models to try to predict which companies might be more likely to fail or to engage in unethical practices.
It's an interesting possibility. I mean, imagine if regulators had those kinds of predictive tools at their disposal. They could step in earlier, maybe prevent things from getting worse, potentially protect a lot of people from harm.
It's like we're moving towards a more data-driven approach to governance, making decisions based on evidence and insights instead of just intuition or tradition.
It's definitely a shift in that direction, and I think it has the potential to be really beneficial. But, as with any powerful tool, we also have to be aware of the ethical implications. We have to make sure we're using this technology responsibly.
That's a really important point. Just because we can collect and analyze all this data,
Yeah.
it doesn't automatically mean we should,
Right.
right? We need to think carefully about how we're using this information and make sure we're not violating people's privacy or, perpetuation biases.
Absolutely. Transparency, accountability, ethics, those have to be central to any conversation about data.
Well said. This deep dive has been pretty eye-opening. We started off talking about, using machine learning to predict S&P 500 changes, and we ended up having this much bigger conversation about the power of data and how it can potentially transform so many aspects of our world.
It really underscores how fast things are changing. We're right in the middle of this data revolution, and it's up to all of us to figure out how to use it for good.
Okay, so let's recap the key takeaways for our listeners, just to make sure everyone's on the same page. First, we learned that machine learning can be used to predict those S&P 500 changes, and it's actually doing a pretty good job of it. And it's not just using those traditional financial metrics, it's also looking at things like social media and ESG scores, which is pretty amazing when you think about it.
We also talked about how those predictions could give investors an edge, maybe even help them beat the market. But as always, we got to remember that these models are just tools.
Right, they're not crystal balls or anything. They should be used as part of a smart, comprehensive investment strategy. And, I think one of the biggest takeaways for me is that this whole thing goes way beyond just investing. We're talking about using data to assess risk, to make better policy decisions, to potentially reshape the way we think about governance. It's a lot to process.
It is. And the possibilities really are endless. It's a super exciting time to be following all this.
It really is. So to wrap things up, I'm going to leave our listeners with one final thought. Imagine you had access to this kind of predictive power. What would why you be most curious to investigate? What mysteries would you want to unlock? Think about it. Maybe you'll be the one to make that next big breakthrough. Until next time, happy diving.